How should you value a startup without revenue? It's a mystery to startup CEOs and how you should value a startup, let alone a startup with no revenue. Why is one startup with no revenue worth $1 million and another startup with no revenue worth over $100 million? I've raised over $100 million in venture capital and private equity funding, and I've helped entrepreneurs like you raise rounds of between $50,000 and $150 million. In today's video, I'll explain startup valuation methods that you can try, the only valuation method that really matters, how investors will value your startup, and the only surefire method to increasing the value of your startup. Plus, at the end of today's video, I'll explain how you should tell investors what you think your startup is worth. I hope you like it. Hi, I'm Brett. On my channel, I help early stage startup CEOs like you raise money and grow your startup. So if this sounds like you, then hit the subscribe button and the bell so you get notified every time I release a new video. Let's get started. Part 1, valuation methods you can try. There are a lot of valuation methodologies that I've heard startup CEOs attempt to use to value their startups with no revenue. However, before I share them with you, I want you to put yourself in the shoes of a potential investor. Ask yourself the question that they're going to ask. Does this method matter to me as an investor? So here they are. I'm just going to go through a few of them for you. Number 1, because we're going to be worth $1 billion someday. Years ago, I met these two entrepreneurs. They were certain their startup was going to be the next unicorn, even though they had no revenue and no product on the market. Now, there's nothing wrong with that. You should believe you're going to defy the odds and be successful. Now, they were about to raise money, and this is where the problem came in. I asked the CEO, Jim, how much money he was going to raise. He said $10 million. Before I could say anything, Jim said, and we'll give investors 5% of the company. Now, that's a post-money valuation of $200 million for those of you keeping score at home. I asked Jim, why do you think investors will agree to this? And this is what Jim said. Because we're going to be worth $1 billion one day. Okay, let's go back to our fundamental question. Does this matter to me as an investor? The answer is no. Investors do not care that you think your startup will be worth $1 billion. In fact, you'll likely scare investors away if you do this. Plus, investors would lose money on any outcome below $200 million. And guess what? Most outcomes are below $200 million, so this will not work. Number 2, the discounted cash flow methodology. The idea here is that you estimate your future cash flows of your startup. Then you discount these cash flows by a rate of return. This gives your startup a valuation if you do this. Now again, here's the question. Does this matter to me as an investor? And again, the answer is that your future cash flows do not help an investor value your company today. In fact, your startup may lose money for the next 7 to 10 years, maybe longer. Uber has been around for how long now? Without making any money. So the reality is that cash flows or negative cash flows do not influence the value of an early stage startup with no revenue. So this methodology won't work. Now there are other methodologies that I just don't want to waste my time on them, but I'm going to tell you what they are. There are about 6 of them, and I've seen entrepreneurs use all of these, and here they are. There's the Burkus method. Now you can look all these up, by the way. There's the scorecard valuation method. There's the cost to duplicate method. There's the risk factor summation method. There's the book value method. and there's the standard earnings multiple method. You can look them all up, they're there. None of them are going to work. However, I can save you the trouble of why these are not going to work. None of these methods will help you value your early stage non-revenue startup with investors. The reason is really simple. Investors just don't care about any of these methodologies. So if you bring up any one of them, they're going to say to you, I don't care, and you're just going to lose. Now, there is one methodology that might hold a little water with investors, and that's the comparable transaction methodology. Now, here's what it is. You do exactly what it sounds like you do with this methodology. You research and find out what similar companies to yours have recently been valued at. The reason this might work is that investors will do research into what similar startups are being valued at. So this is a good tool to use. Now, I'll explain more about how you can use this tool later in today's video. Now, part 2. So how do investors value your early stage startup? Investors want to own at least a minimum amount of every company they invest in. They know that some of their investments will completely fail, some investments will do okay, and some will be home runs with 10x or greater returns. So for their overall portfolio of investments to make a good investor money, they have to own a minimum amount of each company that they invest in. As you can see, this has nothing to do with discounted cash flows or any other valuation method that you come up with. None of them are going to work. So here are some simple rules to give you an idea of what you can expect. This is a table. So you can see here, round ownership, expected and expected return. For a seed round, investors expect to own 10% and make 30x on the return. For Series A, it's 20% and then 10x to 30x. The ownership percentages will vary based on the economic climate, the end market, and how hot your deal is. But this gives you an idea of what to expect. So here's an example. So let's say you're raising a $100,000 seed round. You'll probably be meeting with angel investors in this particular case. And you may do a safe note. So the valuation is pushed to the next round. But let's say that this is a priced round. Here's what it's going to look like for you. The post-money valuation is going to be around $1 million, since $100,000 divided by 10% gives you a valuation of $1 million. As you can see, it's very, very mechanical. One more thing. Investors will not invest unless they believe your startup has the chance of being worth at least, in this example, $30 million or 30x the initial valuation. You will not get an investment if this doesn't hold. Now let's say you raise a Series A of $10 million. The post money will be around $50 million in this particular example. And the only way investors will invest is if they believe your startup has a chance of being worth at least 10 times that, or $500 million. Do you see how this works now? It's extremely mechanical. Early stage valuations are always mechanical. Let's move on to part number 3. How can you increase your early stage startup's valuation when you have no revenue? Now, there's only one way to increase your valuation. You know what that is? Competition for the deal. If there's competition for your deal, where multiple investors are fighting to get in, then you can negotiate for more. I will tell you from experience that this is really, really rare. Remember, for every 100 face-to-face meetings an angel investor or VC will take, they will invest in one company. Raising money is tough. Now, if this content is resonating with you, then please hit the like button right now. Part 4. So how should you tell investors what your startup is worth? Because that's the question, isn't it? What is your startup worth? You're going to get asked. The smartest thing you can do when an investor asks you what your startup is worth, say this: I'll let the market decide. The market is investors. So let them make the first move. Remember, it's always best to let the other side go first in any negotiation. You can always give a counterproposal if you'd like. The only exception to this is if you are raising angel funding from, let's say, 10 investors. Then you're just better off setting a price. Otherwise, let the other side go first. Now, if investors press you for a valuation, then use the comparable transaction methodology and say something like, I've seen companies like ours priced in the range of X to Y. Here's a summary of what we've learned today. Number one, most investment methodologies don't work because investors don't believe these methodologies and they don't use them. Number two, early stage valuations are mechanical, based on a minimum percentage ownership that investors need. Number three, you want to let the market, which is investors, decide the valuation of your startup. You can always provide a counterproposal to anything investors say. Now, what did you learn from today's video? Put your answer in the comments column below today's video. And if you have any questions for me, you can put them in the comments column too, and I'll be happy to answer them for you. Now, I have one more thing for you today. It's my free startup pitch deck template. It has all the slides you need to develop an awesome pitch deck. All you need to do is click the link below today's video, and it's yours for free. And for more great content, click the link on the end of today's video. If you haven't already, then click the subscribe button to get more great content for startup CEOs. I'm Brett at brettjfox.com. Thanks for watching today. Take care. Bye.